Hey everyone, Derrick Oldensmith here, senior trader at T3 Trading Group, and today I'm here to talk to you about a pretty fashionable topic for 2021, which is the short squeeze. Make sure to hit on that subscribe button, click that like button for me. Also next week, starting September 20th through the 24th, make sure to sign up for the Pro Desk Open House, where you will have full access to my virtual trading floor. So, a short squeeze, what is it? Well, a short squeeze is basically forced buying from short sellers who are already in the marketplace. Well, what is a short seller? A short seller is someone who is trying to profit from a stock going down. So the usual thing that we all like to say about trading stocks, buy low, sell high. Short sellers, they're literally trying to do the opposite. They're trying to sell high in order to buy low. The big difference here is risk. So when you're buying a stock, the worst thing that could ever happen to you is that you lose 100%, meaning the stock goes bankrupt, it goes to zero, and your entire investment becomes worthless. But if you're short selling, you actually have unlimited risk. Because where a stock can only go down 100%, a stock can actually go up hundreds or thousands of percentage points, especially if the stock is getting squeezed by forced buying from short sellers. You think, okay, I'm short this stock. Next thing you know, it could be a few days later. We've seen recent examples of it just this year, where now the stock is up 300%, 400%, because as that stock is moving higher, those institutions who might be short, those individuals who might be short, they're getting squeezed out for a loss. Short squeezes really became in fashion earlier this year in January, with the Wall Street Bets community focusing first on GameStop. So GameStop actually had a short float, a short interest of 140% of the outstanding shares. That should be impossible. But because of the concept of naked short selling, funds out there were shorting the stock, selling the stock without even borrowing it. It had the most insane short flow. And when the Wall Street Bets community recognized that, they all came in and they started buying. Their buying forced the stock to go up. Once that stock started to go up, then some of the shorts started to get squeezed. And when you had that high of a short float, it only takes a handful of those heavier shorts to really start buying that stock back. And then what happens is you get a virtuous cycle of buying, where the longs coming in and buying stock leads to the first shorts who are getting squeezed, who are having to buy back their stock at a loss, which leads to the price going even higher. And then the next shorts are getting squeezed, and the next shorts are getting squeezed, all while the Wall Street Bets folks were getting out there and buying even more stock to help facilitate that. And that's how we were able to see GameStop go from a price of about $20 to a price of $500, over $500 one day after hours, in a period of time of a handful of days. And GameStop wasn't all. We also saw short squeezes come into a lot of other stocks. AMC, Sundial, Bed Bath & Beyond, BlackBerry, and there's been kind of constant rotation of these mini short squeezes that now we've been seeing happening all year. I mean, GameStop itself has had 3 major squeezes. AMC's had 2 major squeezes. So there's opportunity there for us as shorter term professional traders. So my team and I now, on a consistent basis, we're coming in and we're looking for what stock could be the next one. Because if a stock could go up 100%, 200% in a short period of time, I want to be able to be there for that ride. So my team and I now are paying attention to stocks that have high short floats. I think anything above 20% is definitely in that squeeze territory where they could really run that thing. And we're also paying attention to triggers that the squeeze could actually be happening. Some of those layers of probability that I've spoken about in a previous video also apply. If we're seeing the heavy volume along with momentum coming in, that could be the beginning of a squeeze. If we're seeing the big institutional long order flow coming into the market, in the options market, that is another signal that a squeeze could be happening. There's a ton of opportunity if you're able to get in these things early when they just start their squeeze. Just because there's a lot of opportunity definitely doesn't mean that there's no risk. there's actually a lot of risks involved in trading these names that are subject to short squeezes that we need to pay attention to. One is being too late. We got to keep in mind, you know what? A lot of these companies, let's face it, they're not necessarily the best companies that are out there, and that's probably why they had really large short interests to begin with. And once the squeeze is over, once the forced buying is done, there's a real risk that that stock is just going to go right back down to its more fair fundamental value. So we want to be careful about being too late and getting in after the squeeze has already occurred. We really want to make sure that we're getting in on the ground floor of that squeeze, getting involved early before it's gone up a couple 100 percentage points, and when the technical setup was still there with the volume and everything else. And there's one other major risk that I feel like people don't talk about enough, which is the risk of a secondary offering for that stock. Maybe people don't realize that that's actually what caused the top in AMC. AMC had that crazy short squeeze. It was actually the second short squeeze in the name. And in one day, I think it went from about $35 to 70 and change, 72, 73, something like that. And then they announced a secondary offering. And the stock went all the way back down to a low of, I think, $35 or so by that very next day. So what is a secondary offering, and why can that be so damaging to a stock that's squeezing higher, and how does that present risk to me? A secondary offering is when a company decides to utilize their stock price to raise additional funds for the company's operations. They're basically offering out additional stock, right? The same way you have an IPO, which is an initial public offering. That's when the first offering occurs for a company. Well, they can always add on more shares to that IPO by doing a secondary. Now let's think about what secondary offerings mean from the perspective of supply and demand. We've got this demand that's coming in, and some of that demand might be from that short squeeze. And you have a limited number of stock supply, which is what we call the stock's float. Now, when you do a secondary offering, that's going to increase the float. So if you've got the same amount of demand and all of a sudden you've got much larger supply because the float is increased, well, supply and demand, that stock is gonna go down. And that is exactly what happened to AMC, and we've seen that happen with a number of other examples. Keep in mind, a lot of these companies, why were they so heavily shorted to begin with? They're strapped for cash. And now they're saying, oh wow, look, our price of our stock just went from, in AMC's case, it was at $2 at the beginning of this year, and now it's at 75. Let's use the stock price to raise more money. That's called being a good CEO or CFO, by the way. You're doing what your company needs, but that also brings the stock price back down. And we need to recognize a lot of times those secondary offerings are announced pre and post market. So you could have a position in one of these names that you're looking for it to continue to get squeezed, and then the next day it just opens up down 10% or more because they announced a secondary offering, and it's a really big risk. And it's all the more reason why you need to make sure that you get in on those short squeezes early when the timing is right and the volume is first coming in. Let's check out some examples of some short squeezes. SPRT has been big talk. This one's been squeezing. It's come back down, currently trading at about $19. According to FinViz, we're looking at a short float of about 45%. ATER, look at the squeeze on this one that's already been occurring. Starting from $4 here just a couple of weeks ago on August 27th, put in a high today on September 13th, that's today, of $19.10. Incredible. So these short squeezes are still occurring, and we are still looking for them on my team on a day-to-day basis by monitoring the volume coming in along with the short float to see where the squeezes can happen. If you like what you learned today about short squeezes and you want to participate in my team, check out the links in the description below. The first one there, that's going to show you how you can join the Pro Desk virtual trading floor. And on the second one, that's my free ebook where you can learn about how you can become a professional trader with T3 Trading Group. See ya.